Hello everyone, welcome back to another video. Today we're going to be talking about how do we as M&A advisors qualify business buyers. And if you've never watched one of our videos, just as a quick background, I'm a Canadian investment banker focused on selling middle market companies. So I typically play in that 1 million enterprise value up to about $100 million enterprise value range. And so this would really apply for a lot of SME transactions. And I would say this video is really relevant for both sellers that are thinking of selling their business and are talking to a buyer and really want to understand, well, how do I separate that buyer and determine whether they're really real or not. And then as well for business buyers that want to present themselves in a better way to sellers and M&A advisors. So this is really a peek behind the scenes of how an M&A advisor would qualify a business buyer. And funny enough, we get this question often from both clients and their teams when they're asking us, well, what is your process to really make sure that we're not wasting time with the wrong party? So let's jump into it. So the buyer qualification process is really a bit more art than science. I really lean on my gut when I'm talking to these buyers, and that comes from years of experience in meeting hundreds and hundreds of buyers to determine whether that person is real or not. And most, but from a question point of view, most of the questions are really common, and you can kind of separate it into a couple of buckets. The first being the buyer background, their personal and family. The second being their financial capacity, so digging into the actual numbers and the wealth behind them to understand, can they actually close a deal? The third is the business buying criteria. What are they looking for, and how does that compare to what we have as a client or what type of business you're in? The fourth is the progress to date, so really understanding where are they at in the process of buying a business. Are they in the front end or the back end? And then the fifth, and unfortunately you can't skip this, is really the live deal experience where, most of the time, the first deal that we show a business buyer is actually not the deal that they close on. So we actually look at a couple, and we have the ability to look at those past experiences when they looked at past deals to say, how do they actually react in those situations? What types of questions did they ask? And that actually helps us determine whether they're really a buyer or not. But when we take a step back, the buyer qualification process differs based on the type of situation in an M&A advisor. So if you're selling your business alone and you're trying to deal with one or two buyers, the challenge is you don't have the opportunity to compare against a larger pool of buyers. So really, if you talk to one and buyer number two, you can compare those two, but you can't compare the other 20 that you talk to. So that's why the power of hiring an advisor that can manage more than two conversations and have multiple conversations is powerful, because it gives that advisor the ability to get a feel for, in that pool of buyers, who's really at the top and who's at the bottom. But in general, when you look at M&A advisors, there's two types of M&A advisors. There's the online business broker, single shingle, or internet-driven type marketing approach, where they're really trying to attack a broad range of buyers. They have a buyer list, they have an email marketing list, and they send out the opportunity to 10,000 people. And that casts a really wide net. Typically, the closing rate on those deals is lower because there's a little bit less qualification in that. You're trying to really cast a wide net rather than tailor the opportunity to the right buyer. The flip side, and this is the bucket we fall in our firm, is middle market investment banks. They don't have an email list. They don't have a buyer list that blasts out to 10,000 people. Typically, we're reaching out to anywhere from about 50 buyers up to about 200 buyers, depending on the deal size. But what that does is it allows us to have a more rifled approach when looking for the right buyer, and that typically also increases the closing rate. So in our deals, we have a very high closing rate. We're probably about 90% close. That's very abnormal. Whereas in the average investment bank, 50 plus is definitely expected, versus the online business brokers that may be in the 20 to 40% range. So my number one comment for you, especially if you're selling your business without an advisor, is don't be afraid to slow down the process and apply some of the questions that we're going to go through and ask those tough questions. A lot of sellers, they're in a hurry, especially when they're alone, and they're trying to get right to the offer stage. But the reality is, most business buyers putting in an offer actually doesn't cost them anything. It's not really that hard. You just put numbers on a piece of paper. The reality is, all of that pre-work before the offer comes in, where you build a relationship, ask the tough questions, that's what allows you to qualify the soft issues behind that offer to really decide whether that's an offer that's going to close or not. So let's jump into the 5 buckets and go through some of the questions. So the first bucket is the personal question. So if I were to meet a buyer for the first time, I probably spend about 10, 15 minutes on that first call, just really understanding who they are to get a sense of their past experiences and the credibility of putting that buyer in front of one of our clients. So my first question right off the bat is, what interested you in buying a business? What is your why? Tell me your story. And that's a great background to say, is this something where you're looking to get rich quick? You saw online they can buy businesses for zero down, blah, blah, blah. I want to put together a deal, raise other people's money and get a fee, but not really do any work? Or have they seriously thought about what it takes to buy a business? Have they come from an entrepreneurial background? Really their story is a great starting point and probably one of the first questions I always ask. Before the call, usually I look them up on LinkedIn. Sometimes they even ask for a resume, and we just talk through on the call their past experiences. So they may not have owned a business before. This may be their first business purchase, but they may have been a manager at another company, a general manager at another plant. So I'll ask them about that experience. Tell me about the company. Why did you leave? How many people did you manage? How big was the company financially from a P&L point of view? Have you ever hired, fired people? Is this relevant relative to the business that we're looking at today? And so, one of the challenges, especially with younger business buyers, is that they may not have the management experience or the P&L responsibility required to take on a business. So that presents a risk, and there's a knowledge gap there. It's not impossible to bridge, and there are people that can figure it out. But at the same time, one of our thoughts as the advisor is, if I have an experienced person versus a younger person that doesn't have the experience, how will our client, the seller, react if we put those two people in front of them? Well, obviously the seller is going to appreciate the experience of the older person versus the younger person may be discounted and may not have a chance. And part of our job is really to separate and not bring buyers that aren't qualified to the table to waste time. Our seller's time is the most important thing. The reason why they're hiring us is that they're trying to outsource the responsibility of selling their business. So we're trying to optimize and bring qualified people. And for us, if we bring 60 buyers to the table, those 60 buyers all have experience and all check the boxes. And there's no question around capability. Another question to ask is about previous business ownership experience or buying experience. So have they been an investor in a past deal? Have they built even a summer business back in college or university? Or have they built a business with their family? Maybe sometimes the family background is just as important where, they didn't build a business, but their dad or their mom built a business and they came up through that business. And, I really, really prefer dealing with buyers that come from an entrepreneurial family business background because they get that soft element behind a deal. Even though they may not have been in the business themselves and they're just children around the dining room table, at least they could listen to mom and dad as they were handling business issues at home. And that gives them an additional layer of understanding of how business actually gets done. And that also helps that person relate more to the client, our client, who is a business owner. And then the last one is just around family situation. So what type of age and stage of life are you? Do you own a home? Do you have a mortgage? What does your wife do? Oh, does your wife work? Oh, she's still going to school? Does she have student debts? Do you have kids? When is your child going to be born? Just digging in and trying to get a piece together the financial picture. A good example is just last week, I was talking with a qualified business buyer in his late 30s, early 40s. Wife is a surgeon, makes $600,000 a year. No questions asked. They are very competent people, and financially, they're not going check to check and going to need to raise money. They have the money already, and the wife is already in a high performing job and will be able to support the other person, their spouse, when they go and buy a business. Versus, say, for example, you have a wife that's still in school, that is pregnant, and now you're also looking to buy a business and you just quit your job full time to search for a business. So the pressures are different, and it's not a prescriptive one size fits all, but it's really the story behind the buyer that we're trying to get a sense at to realize, have they actually thought this through? And again, it goes back down to that gut feeling of, we've seen these stories play out where people are interested in buying a business, they start kicking tires, but that's all they do. They never get to a really substantial, committed phase of buying a business. So moving on to the second bucket, the progress questions. So now I have a good understanding of your financial, family business background, experience. I've looked at your resume and LinkedIn. We've talked through some of your past experiences. So tell me, how long have you been looking for? Have you just started 3 months, or have you been doing this now for 2 years, 3 years, 10 years? It's really important to kind of get a sense of where they're at in the journey. And again, I'm making this more towards the financial type business operator that's looking to buy a business. But in general, we find that most business buyers on average find a business to buy usually 12 to 24 months into their search process. So if you're 3 months into the process, you're just starting to get a feel for the marketplace. And in the back of my mind, really, I'm thinking more about educating that buyer and really providing opportunities to start dating and getting experience with that buyer than actually looking to strike a deal and get something done quickly. It may happen, and it's happened from time to time, but on average, usually business buyers, they're a little bit more optimistic, a little bit more green. They've read the books and they think that what they've read in these how to buy business books translates to the real world, and that's usually not the case. They're a little bit more hardened once they're 12, 24 months into their search and actually have gone through a couple LOIs and understood what it takes to actually get a deal done. So the flip side, however, is sometimes I come across business buyers that have been looking for 10 years. That's not good either, because okay, well, the question is analysis paralysis. Like, if you've been looking for 10 years, why haven't you bought something? Like, there's a lot of businesses out there. What's going on? So really, it could either be too short or too long, but typically once they're 1 to 2 to 3 years in their search, that's the sweet spot. They've done enough work that they've gone through this a couple of times. They're not going to be green. It's not the first time putting in an offer. So that's a good kind of green flag for me. The second one kind of feeds off the first one is, have you submitted any offers so far? So, I love asking this question. And I find that when sellers sit in front of a business buyer alone, they forget to ask this question. So I really would mark this question down. If you're trying to sell your business alone, really talk to that buyer about past offers. What have you looked at? What types of offers have you put in? And really dig into that. Tell me about that deal. What type of company was it? How big was it in terms of revenues and EBITDA? We put in an offer. Did you come in second? Were you, bottom? Why didn't it work out? Oh, you signed an offer. That's great. Okay, so you were in diligence with that offer. Tell me about what happened. Why did diligence not go well? Why didn't you close? What did you uncover? And so you're trying to piece together, again, this goes back to that gut. And there's a lot of experience that comes with this. But, sometimes you hear stories where, I'll give you a really good example. I was talking to a buyer looking for probably about 5 years, and he's put in about 22 offers that have been signed back and failed in due diligence. That is probably one of the biggest red flags. It's a bad case, but I hear that and I'm thinking, wow. I mean, even though if I get an offer out of you as a buyer, is it going to close? The likelihood is very low, because look at the other 22 times that happened. Versus it could be 1 or 2 times, and that's totally fine. Most business buyers, they're going to put in 1 or 2 offers and walk away. That's not bad, but talk to them about why they walked away. Was it a deal-related item? Was it a lack of disclosure from the seller, a lack of trust, or was there conflict that came up at a certain point in negotiation? And you'd be surprised how buyers share a lot, right? They want to talk about their past deals to really qualify themselves. So they're going to give you a ton of information for you to figure out, what type of person am I negotiating with? Is this an aggressive negotiator, or are they a little bit more passive? Are they really trust-based? And the moment you compromise that trust, the deal's dead. What does that look like? And so really getting those lessons from the past deals is critical to getting a sense of this buyer's style and how they deal with issues. And then the third question I always ask is, in terms of the opportunities they're looking at today, so not in the past, but today, are you looking at one company? Are you looking at 10 companies? How many offers do you actively have today? And that's a really powerful question, because sometimes business buyers, they really want to cast a wide net and cover off their bases. They want to look at 10 opportunities, knowing that it's going to be really hard to get to the finish line. So they may put in 5 offers and split their time between those 5 offers. The challenge from an M&A advisor point of view and from the seller's point of view is you're spread too thin. And that's my biggest concern is when I hear people that have multiple offers on the table, the question is, how do you prioritize those offers? If you have, say, for example, 3 companies on the hook right now looking to buy, and information comes in on all 3 on the same day, which email or package do you open up first and read through first? And how you prioritize those opportunities will really decide whether that buyer is really, really interested in you or just looking to stay busy and cover off their bases and have a backup opportunity. So we always kind of dig into, what are you looking at? How many offers do you have at right now? Do you have the resources or the team to analyze multiple deals? Do you have analysts or investors that are helping you, or are you just doing this alone and you're trying to figure it out alone? So that's another question to ask. Now, moving into the third bucket, so now we've talked about the background, we've talked about the progress to date to get a sense of their experience and I would say their realism with regards to buying a business. The third bucket is the search itself. Tell me about the search and what you're looking for. And so when we qualify buyers, we kind of put them into multiple buckets. So, in our CRM, we have different tiers. The first is geography. So oftentimes, especially if it's a mid-career person, they may own a mortgage, they may have children, they may have a wife with an established career or a spouse with an established career. So really, are they open to moving? What's that radius in which they can really look at buying a business? And most people, I'd say, are within 1 to 2 hours of their home at most. But sometimes younger buyers or buyers that are a little bit more flexible or heavily committed to really kind of hitting it out of the park with an acquisition are committed to leaving and moving further away. But one of the things that we always say is we want to be really honest with that, because sometimes people look at opportunities that are outside their radius just to look at it for fun. Well, we're not looking at these things for fun. We're busy people. And if it's not a fit from a geographic point of view, we just pass on the opportunity. So very quickly, that is a key determinant for us. The second is going to be the business size itself. So understanding the price and the EBITDA. So, are you looking at businesses between 500,000 in EBITDA and profit up to 5 million in profit? Are you looking at businesses within 500,000 and 1 million? Are you looking at businesses that are 5 million up to 10? What does that range look like? And, again, going back to the past question, past deals, when you talk through past deals, ask about the numbers behind those deals. What was the purchase price? What was the revenues? What was the EBITDA? Because that will give you a good sense of what type of size they're looking at. The third is industry. And the challenge I have with most business buyers is they really fail to commit to certain sectors. They will obviously say, I'm looking at everything. I want to find a business that is really good. I'm industry agnostic. It doesn't matter what type of business I'm in. Well, the challenge is if you haven't looked at a specific industry, or you don't really have defined target industries, then it's really tough to figure out what that buyer really wants. So we try to dig in and really understand, even if you don't have specific industries that you're looking at, what have you looked at in the past that has really caught your eye? What are certain sectors that you've read into or seen an opportunity in that have gotten you excited? And that gives us a really good understanding of at least some benchmark industries to say, I really, really like this food opportunity, or really, really like this retail distribution opportunity. Okay, perfect. More B2C, more retail type businesses are going to be a fit for that person, versus they could say, anything manufacturing, I just don't understand. I'm really struggling. Okay, then probably no manufacturing opportunities. We really try to tailor it to the specific industries that's a really strong fit. And then the fourth one, and it's a big one, is, so what type of management deal or transition is that buyer looking for? So, the question we ask buyers is, are you looking to get into a full-time job and you become the president and run that business? Or are you looking to buy a business and have someone else run it for you? And those answers are going to separate the conversation to two different ways. If they're looking to run the business themselves, then it goes back down to their experience questions, which is that bucket number one. But if they're not looking to run the business and they're really looking to hire someone, the next question is, who do they have in the wings, or how are they going to recruit that person to come into that situation? Because one of the challenges we find is sometimes people say, I'm not going to run it, I'm going to hire someone. And they have no idea how to hire that person. And the reality is it's really hard to hire good quality people. The seller would have done it themselves if they could. So there is work behind putting together a team. And so if they've never done that before in the past, where they've recruited or put together a team, the chances of success of that happening are lower, which is a risk in our eyes. So we oftentimes either will work with buyers that have really competent operators already, or buyers that are looking to run the business themselves. But rarely do we try to take a gamble on a buyer that's looking to hire for that role, unless they've demonstrated they could do that in the past. So, summarizing kind of the things I mentioned here, the first, bolded point here, the reality is the more defined the search criteria, the more I would say focused that buyer is and the more realistic that buyer is. The less defined the search criteria, well, then that buyer is looking at a lot of opportunities and they're trying to look at opportunities to figure out what they really want. And the reality is my client and my time is not worth that, really. The reality is you should probably know what you want if you want to play the game. But if you don't know what you're looking for, then really that's probably not a good, sign. So typically we shy away from dealing with people that have very broad ranges or ill-defined search criteria, or they're open to looking at it and anything. We often hear, like, sometimes buyers will throw out this comment. It's like, well, put me on your buyer list. I'd love to just look at all the opportunities you have. Absolutely not. We've never done that. We're never going to do that because it's a waste of time. And as well, why would we be sharing information about our clients if that's not really a fit for you? So there's that balancing act of definitely from a seller's point of view, being really rigid and looking at that buyer and saying, does my business really meet your criteria, or are you just looking for the sake of looking to learn? Because in that case, then just manage your expectations and realize that maybe that buyer is looking at 100 to 300 deals a year, and you're just one of them on that list. But don't invest a lot of time or fees to advance that process without really seeing a real level of commitment. So, I've kind of talked about this second bullet point here, which is, tell me about the past businesses, really getting a sense of strategy. The other key question is from a size point of view. So going back to the business size bucket, are they playing in the right lane? Sometimes we'll ask business buyers, tell me what range you're looking for. And they're like, well, I really want a bigger business with established infrastructure and established middle management team. So something in that $10 to $30 million business value range. And then we dig into the financials behind that buyer, and they barely have maybe $200,000 in investable assets to go and buy business. Well, that means you're going to have to raise a lot of money to put together a deal, and that's a lot of risk. And so no money buyers are really the lowest level buyer that we deal with. Now, sometimes they're important because they provide a floor and an option for certain situations. But at the same time, from a seller's point of view, they present a higher level of closing risk because they have to go and identify where to raise that money to close that deal. So this is a very big question for us. Are they even swimming in the right lane? Are they realistic? And we'll push back. Like, we're respectfully, in a respectful way, we'll say, hey, listen, the challenge with that is those are big deals. Like, you're going to go up against private equity and larger strategic buyers. How do you rationalize being competitive in that bigger range? And if they don't have really a strategy behind that, then most likely they haven't really thought through their business search criteria that fully. Another one to think about, and again, I can't believe people don't ask this, but say for example, you have a business buyer that's gone through this process a couple times, trying to put deals together. I will always ask, what types of multiples have you paid on those past deals? Tell me about multiples that you're willing to pay. And you'll be surprised how many buyers are like, well, I try to pay 4 times for this and 3.75 times for this, but only 50% cash down. And they show you the way they've structured deals in the past, and it shows you the level of aggressiveness that comes when it comes to valuation. Some people, they know what market is, they're comfortable in paying with market. Other times I've asked buyers and they're like, well, I'm no interest in paying more than 3 times and more than 50% cash down. Okay, well, then you're not going to be a buyer in our processes, so let's just move on. So, it's really kind of making sure, do they have a realistic expectation of market prices, or are they looking for a deal, which is not really a type of buyer that we deal with. Okay, and then the third one, or the last one here, about stepping full-time, we've talked about this. In which direction do you want to go? So moving on to the fourth bucket, the financial question. So this is the nitty-gritty. So here I would say online business brokers, they do a really good job of, even before they pick up the phone and talk to a buyer, they're going to ask for a personal net worth statement. And I would say we don't do that because it's a little bit taboo, to be honest. Like, we don't get into the personal net worth statement unless we absolutely have to. And the only times we've really done it is where we've chosen a buyer that has the need to raise money. Okay, so something's happened, we've gone through the process, and you know what, like, the seller is okay in accepting the risk of the equity raise risk and dealing with that buyer, and they've given us the go ahead to say, okay, we'll take that deal, and work with the buyer and give them time to raise money. Okay, in that situation, then we actually lean into the race and support the buyer. Give us a personal net worth statement. How much are you putting in? Walk us through your financial model. We may have some investors that we can bring into the deal as well, and really supporting that, because obviously from our point of view, we want to get the deal closed and we want to support the buyer if we get to that point where we're open and accepting of that equity raise risk. But other times, and most times I would say, to be honest, we don't want to deal with those types of buyers because it presents a higher level of closing risk. And there's a lot of other buyers out there that have good, strong net worth. They have capital behind them. They come from wealthy families or friends and family that are supporting them. And therefore, it's an easier buyer to justify dealing with in terms of making sure that they're qualified. So a good rule of thumb to think about is that the equity that the buyer is going to bring to the table should at least match the EBITDA size of the business. So for example, if you're selling $1 million EBITDA business, give or take, that deal may need about $1 million in equity. So, just to walk through those numbers. So, and here's an example I used with the $2 million. So in $2 million EBITDA business, if that were to sell it for 5 to 6 times, that means it's a $10 to $12 million transaction. The bank is going to give you about 50%. The seller is going to come in usually about 25%, sometimes 30%, sometimes 20%, but give or take 25%. And then the balance of 25% is what you're going to need to put together that deal. So here it shakes out to be about $2.5 million to $3 million. I've seen deals where, maybe the bank comes in at 60%, the seller comes in at 30%, and then the buyer only needs, $2 million or $1.5 million. But give or take, I think a good rule of thumb is the EBITDA should equal the equity check. So if you're the seller and your EBITDA is about $1 million, when I ask the financial questions, I'm really looking for, do they have that $1 million themselves, or do they have to raise any of the money? And so the first question is, how much investable cash do you have to personally invest? And the power of this, and I really, really recommend this, is ask these questions multiple times in multiple conversations. Sometimes I'll ask that question twice, at the beginning of the call and again at the end of the call, to see if their answers changed, or maybe in the second call, just to reaffirm and confirm. Because I've had instances where, unfortunately, buyers will say, oh, I have $2 million to invest. Okay, I take it at face value. Later on in the process, I find out it's only $500,000. Oh, $2 million, up to $2 million, but we're going to put it in only $500,000. So it's really, I would say, important to be very specific when asking financial questions and drill down and saying, okay, where does the money come from? You say you have $1 million. Is that cash, stocks, bonds, preferred shares, or is that tied up in your house? Okay, it's tied up in your house. Have you spoken to your spouse about taking a second mortgage out to access that? How much are you realistically prepared to lever up your home residence to take money out to go and buy a business? How much is your limit in terms of equity risk? And so the more specific the questions, the more difficult, especially from a character point of view, it is to try to hide from that question. Now, some people will just lie, and unfortunately, you find that out later on, or later on in the process. But for most buyers, they're good buyers. Like, people are honest, and they realize that, listen, like, this is an important question, and we make it very important on the first call. Talk us through the equity side of your personal balance sheet. And then there are other times where, do you have friends and family? What about your parents? So maybe earlier on in the first bucket, we asked about a family business, and they mentioned, oh, well, my mom and dad, they own a large manufacturing company. Well, then my follow-up question when we talk about financials is, what about your mom and dad? Are they prepared to put money in? Have you talked to them specifically about how much they're willing to come in with? And if they say, oh, my dad said no, he's not going to put in anything. Okay, a little orange red flag. Versus it could be, no, my dad's prepared to back me for an additional $1 million. And we've seen that, like we call it the bank of mom and dad. Sometimes there are those bank of mom and dad business buyers that are absolutely perfect, because the bank of mom and dad have business experience. They're coming in, and there's no outside investors. It's just really the family that's buying that business. Now, another one we really dig into is the investor. So say, for example, okay, no friends and family. I have $1 million. I'm going to need to raise some money, but I have investors. People are going to say that all the time. I have investors. Okay, well, when you say you have investors, who are these investors? You talk to me about them. Yeah, how do you know them? Did you meet them on LinkedIn or at a conference where, I'll back you. You bring me a deal? because there's a lot of those investors out there that are floating around, offering the opportunity to other operators to say, oh, bring me a deal. I'd love to see something from you. And the only reason they're doing that is just to see the deal, not to actually back the deal. So, how close are you to those investors? Have you had previous experiences where you've looked at those deals with those investors? How have they reacted? So we really want to get in and going back to situations where we've picked a buyer that there is some equity raise risk. At the LOI stage, at the letter of intent stage, when you're going to sign the offer and go exclusive, we always ask to actually call the investors. We want to talk to them, the people behind you, to make sure that they've looked at the opportunity and they've been able to provide their opinion. Because sometimes what ends up happening is a buyer will put in an offer and they won't run it by their investors until the offer is signed and they're in due diligence. And that presents the challenge of, and we've had this, and won't name names, but just under 2 years ago, we had business, fantastic business. Ultimately chose these guys. There's great chemistry fit with the sellers. The guys sign up the deal, and within 4 weeks they walk away from the deal, and we are just like dumbfounded. Like there's nothing going on with the business. It was doing well, but the challenge, and they flagged it, was that, oh, well, we started to dig in and our investors realized this isn't really the opportunity they thought it was something else. And so to me, that was just a lack of dialogue with the investors. If we had the chance to tell the full story to those investors, we could have gotten to that answer before signing an offer and wasting 4 weeks of the seller's time. And remember, from the seller's point of view, this is a very emotional process for them to go through and expose themselves to a buyer, to open themselves up to selling their baby, to selling the business that they've built over the last couple of decades, and then to pull out so abruptly, creates a lot of tension, and it creates fatigue for the seller, which is why we're there. As an intermediary, we're trying to smooth out the tension that comes between the buyer and the seller to ensure that the seller has the stamina to get this deal done, to get to the finish line in the least painful way possible. So we really want to dig into the investors as well. So I think, if I were to flag one slide that sellers don't do a good job of when they're trying to sell their business alone and just deal directly with the buyer, they don't ask these questions. I don't really hear sellers because, again, they don't have the experience to. But if you're going to do it yourself, make sure you really take the time. And usually we have probably 1 to 2 hour long calls with buyers. It could be one full shot or 2 or 3 calls at a time where we dig into these 5 buckets and really get a sense of if this buyer is real or not. So the fifth and last bucket that we focus on now is, okay, great. We understand the family background, the experience. We understand what they've done to date and what they're looking for. We understand their financial situation. But the reality is we have to get in there and actually start looking at a deal together. So I call it the dating period. We actually need to look at a few opportunities. And rarely do we find that the first deal that I show a buyer is the deal that they're going to take, because I actually need that dating period myself as the advisor to really show some opportunities and see what feedback they provide. Oh, I don't like this. I don't like that. Ooh, old management team. I can't work with that. Oh, a key customer concentration. Don't really like that. That makes me really nervous. Can't get comfortable with that. So you get a sense of the types of risks that specific buyer can work with, can get comfortable around, versus they just can't get comfortable, and they're never going to get comfortable, and so long as you could force something on them, but it's just not going to go through. So that's why, to me, I like showing that 1 or 2 opportunities first. Usually by the 3rd or 4th or 5th opportunity, we're really getting into the brass tacks of opportunities that they really want. And so the one thing that we always do in our deals, especially at Robley, is that we focus on a 2 offer stage process. So that means instead of talking to a buyer, showing information, and then expecting an offer to sign back, we actually do 2 offers. So the first offer is an expression of interest. It's an EOI. And so what that offer does is it essentially separates really the buyers that are either looking at the opportunity and have no interest in ever bidding for the business, but are just asking questions for the sake of asking questions. And then it also separates the buyers that throw in an offer that's a low ball or too low of our expectations. And that EOI, to me, is really the end of the dating period, because at that point in time, either you're really serious about this offer and you're going to put in an offer that's strong from a valuation point of view, or you may put in an offer that's less defined, doesn't have a lot of information, is preconditioned with 10 different things that you need to see, and that gives me a feel for how that buyer specifically will views that opportunity. So I always recommend that when you're working with a buyer, don't spend 5 weeks giving them all the information and expect to get a letter of intent, a bigger, fuller document. Quickly advance the discussion, give them enough information to put together a 1 to 2 page document, which is an EOI, and ask them, even give me a range, X to Y. What do you think you're going to come in at from a valuation point of view? So you can quickly separate the low ballers from the people that view the full value for the business. And that feeds into the comment about lowballing. So sometimes we deal with buyers, and I've had some really, really, really good buyers. Like, again, I had a guy a couple months ago, a billionaire. Really, everyone was like, "Oh, you got to meet this guy. He's perfect. He's got tons of money. He owns 15 different businesses. Talk to him. Talk to him." Okay, perfect. Talk to the guy. Really nice guy. He's got all the medals in the world, and we start looking at deals. First deal, he comes in like low. I'm talking insultingly low, and like 80% below everyone else. And I was like, okay, dig in. I ask questions like, why is the value so low? How do you view this business? Oh, this risk. I'm good for the money, but I'm not willing to pay. Blah blah blah. Okay, so second chance. Try to give him an opportunity to rebid on the business. Tell him kind of where everyone else is, and he's firm. He's like, no, I'm not moving. I'm not budging. This is how I am. And so that's enough for me to know that that's a buyer that we're not going to show another opportunity to. Even though the guy's a billionaire, he owns all these businesses, his style and the way he values businesses does not align with our expectations and obviously just market valuations. So we're just going to move on, and he's off the list. And so I kind of call it the penalty box. Like buyers that just keep lowballing deals, you're in the penalty box. Good luck. We're not going to talk to you, because why would we waste our time trying to sell you on the next deal if you can't meet value expectations from a market point of view. So, and outside of just the valuation at the EOI stage, the other thing that I really focus on when we're talking with the buyer is the questions they ask. So I'm just thinking of another story. So this was a smaller business, and it was a financial investor, and he starts asking questions about insurance. And I'm talking, we spent probably like 30 minutes on liability insurance and the risks and the blowback and what happens, have they previously had instances? Do customers enforce it? And it was just like a really weird conversation around what I would call a secondary issue. Like it was a manufacturing business. They just sold forklifts. And it was just, there wasn't any liability. There was no active lawsuits. The business was perfectly clean for the last 15 years. But this person was so hung up on the personal liability behind owning that business that to me it was a red flag to say, okay, this guy just can't get past this risk. He can't get past the risk of being a business owner. And so sometimes people will say all the right things, but then when you actually get to the reality, which is being a business owner, there's risk. And if you can't get comfortable with that risk, then you're not really a business owner type. So we pulled away from that buyer. And there was a few of those buyers where, there's another one, where every single deal we showed, the guy came back with probably like 70 questions to get to an EOI. Not even just a rough expression, give us X to Y. We're not asking you to commit to anything. Just give us a range of how you think the value of this business is. And it takes a full hour to answer all those questions, and it's burdensome for the seller. And so we're looking at that and we're thinking that's a very high maintenance buyer. And so from our point of view, we don't want to work with high maintenance buyers if we don't have to. If we have to, we have to, and that's just another situation. But if we don't have to, and it's a strong deal, there's all these other qualified buyers out there, and there's a huge buyer pool nowadays. Like I would say, buyers have like tripled in the volume of size of the number of buyers in Canada, especially in the Toronto region. It's unbelievable. So there's more than enough options to go to the next guy, especially if that buyer is really intent on either focusing in on secondary issues that aren't really issues, because you just really need to separate the buyers that are quick, that understand how business is done and understand how to get a deal done, versus those that you can see their insecurity and their lack of risk-taking ability presents itself at this stage. That's a red flag in my eyes. So that gives you a good overview of those 5 buckets of just the other areas that we look at from a financial investor and individual operator point of view. So now I'll quickly touch on the strategic buyer analysis. And to be honest, I'd say about 70% of it's the same. Like it's not that different, but we ask specific questions of strategic buyers and spend a lot more time on the front end before we ever share our client's name and go to an NDA. And the reason being, with strategic buyers, the risk is that you may have a strategic buyer, and I know this. I've heard from strategic buyers multiple times that they're like, oh, like I just sometimes sign deals just to look at it. Like I just want to see what they do, what their margins are, what kind of markets. It gives me an idea of where to take our business. And we want to avoid those buyers completely because that just empowers a competitor and then at the same time exposes our client to risk. So, part of our job as the advisor is to get a gut feel for, are these guys kicking tires and they're just looking to kind of get some action and learn something, or are they actually serious? And have they, thought through, buying a business? So even before we sign an NDA, we ask these questions, these bullet point questions here, because these will give us a really, really good understanding of, are they serious or tire kickers? The first one, and especially for strategic buyers, is who's the decision maker in the organization and how old are they? So am I talking to the decision maker? Am I talking to a VP of M&A, or am I talking to the CEO? Am I talking to a CFO that is going to pitch this idea to the owner? Who am I really talking to? Because the challenge is you want to get in front of that decision maker as quickly as possible. Because if there's hired people that are presenting opportunities to the ownership group, you may have a really good conversation with that hired person, but the owner may just view it differently. So it's important to get in front of the owner and say, chief to chief, I want to have that conversation with the owner, the person that's actually writing the check. Are you looking to buy this business? Does this business make sense for you? And then the question behind the age question is oftentimes owners, especially if they're the sole owner, there's no second generation in the business. If they're in their 70s, it's a very low likelihood that they're going to look to buy a business, to be honest. We approach strategic buyers all the time and have those early conversations. And, you can just see it hemming and hawing. It's like, oh, this would have been great if it was 10 years ago or 20 years ago. But M&A is really hard work. There's a lot of risks, the integration work behind it all. So from a strategic point of view, we want to look at the age of the team and the age of the owner to get a sense of, do they have the energy and the capability to actually go through with this deal? Because sometimes they wish to do it, but they're actually not really that serious enough. The second one is, talk to us about the M&A strategy. So have you thought about this? Like, is this a really defined path for you? Why does M&A make sense? What types of companies are you looking for? And oftentimes it's very cheeky, but I do this. I'll call a company, or we'll set up a meeting with the company with a high level teaser summarizing this opportunity that's related to them. And even before we get into our opportunity, I'll take it away from that opportunity. I'll say, what types of business are you looking for? Talk to me. Like, what is a good fit? What are your business needs right now? And this is more just business acumen to really kind of partial out, well, what is really a good fit? Because if our client is not a good fit, if they clearly define, we need to hire labor, we need to expand into this, and this client is not in that area, then, it's nice to see, but it's not a need. So, again, it's a gut call to say, have these guys actually thought through their M&A strategy? Do they understand what they want? And then does my client actually fit their need? If it doesn't, and there's not a really clear rationale, I get a little bit more hesitant and I start probing, and I'll even ask the question point blank. Okay, just based on that question, based on that answer, I'm kind of scratching my head thinking, is this even a fit for you? I don't want to waste your time. I know your time's really valuable. And sometimes people will be like, you know what? Yeah, you're right. And challenging the buyer, the strategic buyer, and saying, is this even a fit? I don't want to waste your time is a great way for more honest buyers to say, you know what? You're right. Like, I took this call just out of courtesy to see the opportunity, but just thinking through this, it doesn't make sense. So we just want to make sure, we just want to avoid situations where we're sharing our client's name with a strategic buyer, obviously post MDA, but we just don't want to get those tire kickers out of the way. The other one is the acquisition experience itself. So this kind of feeds into the similar questions from the financial buyer point of view. Tell us about past acquisitions. Have you done acquisitions? Have you ever done one before? Tell me about those deals. Did you hire someone to do that? How did those deals work out? How did you pay for those deals? Did you use bank debt? What type of multiple did you pay for those deals? And just getting, again, be fearless when you're asking these questions, because the worst they can say is no, I'm not going to tell you. It's none of your business. Great, you move on to the next one. But oftentimes people want to share. They want to, provide that credibility to say, no, we're serious. We've done this before. But the line of thinking here is that if you talk to a strategic buyer that's never done a deal before, they've never looked at a deal before, and they have an older management team or the owner, there's no second generation in the business, the question is, are they going to learn this deal on the go? It's a really tough sell. Like usually either the strategic buyer has defined M&A as a path to grow, they've done M&A deals in the past and they're a proven acquirer, or they've never acquired a business, and the likelihood of that strategic buyer actually going and acquiring that business is very low. So oftentimes what I do is when I meet with a strategic buyer, even before I take the call, I'll Google their name, I'll add an acquired M&A question mark. And just to see, have they been mentioned in any past deals that they've done? And maybe they've invested in stuff, but if they're really conservative as a company, they've never done an M&A deal before, it's very unlikely or lower likelihood that they're going to bite on this and seriously look at it versus maybe just sign the NDA to take a look. And then the other one is next one is kind of just the acquisition size. So, how big are these guys? Are they about the same size? So I always kind of, I respectfully ask, is this something that you can afford? Like, revenue wise, is this kind of half of your business? Is this kind of, are you about the same size? And, they'll share less about profit, but they'll give information about revenue, about employees, about the real estate that they own, how many facilities they're in, who do they bank with, do they have any debt, and again, it's easier to ask these questions as an intermediary versus if you're a strategic competitor. Imagine calling up your competitor and saying, hey, what's your sales? Do you have debt? Who do you bank with, right? So that's the power of hiring an intermediary. We can kind of go a little bit more under the radar and ask these questions to get away with them. And I would say, probably more than 2/3 of the time, I get answers to these questions. And it's beautiful. I come back with a full list to our client and I'll say, here's what we talked about. We had a 45-minute discussion. What do you think? Do you want to proceed to the next stage? And we make sure that our client always signs off on who we talk to. And even we report back on information to make sure that the client's aware, hey, listen, like these guys seem serious. I think we should take the next step. Because we're very serious about confidentiality. We do not want to get in a situation where there's just tire kickers. That's a disservice to our client. And then the last one is current performance. So, this is just, I'm recording this in 2024, but, one of my favorite questions to ask in the last couple of years is, how's COVID been for you? Oh man, it just opens a can of worms. Start talking. Oh, this, this was really bad. This was really good. We did really well. And it just gets them starting to talk about their business. But really what I want to understand is, are they doing well? Is the trajectory of the business going up? Is it faltering, going down? If they lost a customer, are they facing headwinds? Because the challenge is most businesses that go, strategic buyers that buy businesses, they're either growth-minded, they're either doing very well and they have excess cash. Very rarely do we find strategic buyers that are losing money or declining or facing headwinds, and they also want to now distract themselves with a strategic acquisition. It just doesn't make sense. Doesn't. It usually doesn't. So usually a poor performance is a bad indicator when you're talking to a strategic buyer. But, once you get a sense of the size of the business, the question is, from a relative size point of view, if our client is $5 million in sales and they're $500 million in sales, that gap is too big. I find that if you're within, I would say maybe like at most, 5, maybe 10x at times. But the challenge is, it takes a lot of work to buy a business. It's actually probably about the same level of work to close a 5 million sales deal as it is to close a 30 million sales deal. So why would a bigger company look at buying a small company? And oftentimes we have this conversation with our clients where we say, hey, listen, you're too small to really attract international buyers and US strategic buyers or whatever, because it's too much work to go through the hassle of buying such a small little subsidiary. Versus if the strategic buyer is maybe 2x or 3x the size of our client, that's a really nice bolt-on fit. It's enough bang for their buck to really add a third to their business or 20% to their business and go through the process of integrating. So relative size is also important. A strategic buyer could be either too big and it's just not worth the work, or they could be about the same size. And then the question is, okay, you're looking to double your business now, right? If you're 10 million in sales, our client's 10 million in sales, you're going to double the size of your business. Do you have the capacity, the expertise, the risk appetite to do something like that? And to be honest, most times, no. Unless it's a really young, strong operator, most business buyers on the strategic side, they'll look at those smaller bolt-ons that are lower risk versus trying to swing for a home run and double the size of their business or go for something bigger. So the strategic rationale is everything when we're talking about strategic buyers. Can we really make sure that it's a fit or not? So again, goes back to gut, but hopefully this gives you at least a good understanding of some of those questions. So in summary, when you think about kind of the buyer analysis process, as I mentioned, don't be afraid to ask questions. Take the time. Usually we have a 45 to 60-minute intro call. Then we have another 30-minute call in the next meeting. And usually these relationships are multi-year. As I mentioned, it's not like on the first deal they're going to buy the business. So I've been talking to buyers now for 5 years. Seriously, 5-6 years. And we haven't gotten anything done, but I know what they're looking for. I have a really, really good, strong grasp of their criteria and what's a fit and what's not a fit. And if I'm going to bring something to them after dealing with them for 5 years, I'm almost always going to get an offer from them because I know it's a fit. It's now just a question of, are they going to be competitive enough to win the deal? But don't be afraid to don't rush through this early part of the relationship. Really take the time. And so here I highlighted the top questions. In terms of background, tell me about the past management experience. Do you have sales? If you manage people, and tell me about the why. Why are you interested? Does your family own a business? What really pulled you in this direction? From a financial point of view, how much cash equity do you have to invest personally? Ask that twice over. Make sure you ask that to see if the answer changes. Do you have friends or family looking to invest? How much? And what about third-party investors? Who are they? Let me talk to them. Search criteria. What are you looking for? How long have you been looking for? And tell me about the criteria and see if they're really realistic about the types of businesses they're looking for. And are they looking to run it themselves or hire someone to do it for them? And then from a progress point of view, how long have you been looking for? How many offers have you submitted? Tell me about those offers. It's such a good question. I get so much information out and it's powerful. From a buyer point of view, you want to share that information because it encourages a credibility and it encourages, that broker to really understand what you're looking for and why deals failed in the past. But from a seller or a sell-side advisor point of view, you now have really good information about the style of that buyer before ever getting to an offer stage. And once you have a good sense of what they're looking for, you can be very realistic to say, this is a fit or not. And if not, just move on. Don't waste your time with bad buyers. Bad buyers cost you money. They waste your time. They can do damage to your business. Just move on. And oftentimes, I would say probably 20% of the buyers that come in through the door, we don't have a second call with them. They're just not a fit. Just move on. And the reason why is our time is just as important, and we want to make sure that we're focused on the right types of buyers. So hopefully that gives you a good overview of the buyer qualification process. There's a lot of psychology and gut to this one, but again, there are a lot of common questions that you can ask whether you're the seller or you're looking to just improve your M&A process as well. So if you have any questions, please do reach out. Happy to connect on LinkedIn or go to our website, register for the newsletter, and send me an email. I'm more than happy to set up a call and just share more about kind of how we think through the buyers as well. So thanks for watching, everyone, and have a great day. Bye.